Welcome to our deep dive into the world of bonds, a critical component of the global financial system. In the next few minutes, we will unravel the concept of bonds, shedding light on the integral role they play as a form of investment. Let's start with the basics. Imagine you're lending money to a friend. In return, your friend promises to pay back the borrowed amount, plus some extra as a thank you for your help. That's essentially what a bond is, a loan that you give to an entity, be it a government or a corporation. In the world of finance, this entity is known as the issuer. The issuer sells bonds to raise capital. When you buy a bond, you're essentially lending your money to the issuer. In return, the issuer promises to pay you back on a specified date, known as the maturity date, along with periodic interest payments until that date. This brings us to the face value of a bond, also referred to as the par value. This is the amount that the issuer promises to pay back once the bond reaches its maturity date. The periodic interest payments, on the other hand, are based on a percentage of this face value, known as the coupon rate. So, in essence, when you invest in bonds, you're playing the role of a lender, and the issuer is the borrower. The bond is the promise or the agreement that the issuer will pay you back your initial investment, the face value, along with interest, the coupon. Bonds are a popular investment choice for those seeking a steady stream of income and relative safety of principal amount. They are, in fact, one of the largest components of the global financial market, with trillions of dollars invested in them worldwide. Now that we've covered the basics of what a bond is, let's delve into the different types of bonds available in the market. Bonds come in various shapes and sizes, each with its unique set of features and risks. First off, let's talk about government bonds. These are issued by national governments, and they're usually considered safe because they're backed by the full faith and credit of the government. But remember, even governments can default on their debts. The returns on government bonds are typically lower compared to other types of bonds, reflecting their lower risk. Next up are corporate bonds. These are issued by companies, and they carry a higher risk compared to government bonds. Why? Because companies are more likely to default on their debts. However, the higher risk comes with a higher potential return, making corporate bonds attractive to investors seeking higher yields. Then we have municipal bonds, or munis for short. These are issued by local governments or municipalities to fund public projects, like schools or highways. Munis are generally considered safe, and they have a unique feature. The interest earned is often tax-exempt. We also have savings bonds, which are non-transferable government bonds that are designed for individual investors. They're low risk, but they also offer lower returns. There are also other types of bonds, like agency bonds, mortgage-backed securities, and even foreign bonds. Each of these has its own set of features and risks that investors need to consider. It's also important to note that bonds can be either secured or unsecured. Secured bonds are backed by a specific asset, like a building or piece of equipment. If the issuer defaults, the bondholders have a claim on that asset. Unsecured bonds, on the other hand, are not backed by a specific asset. They're riskier, but they also offer higher potential returns. In short, there's a wide variety of bonds out there, each with its own risk and return profile. It's crucial to understand these differences before you start investing in bonds. Understanding the different types of bonds is the first step in navigating the bond market. Next, we'll look at how to buy and sell bonds. Buying and selling bonds may seem complex, but once you understand the process, it becomes much simpler. Let's start with the basics. Bonds are traded on the bond market, similar to how stocks are traded on the stock market. But unlike stocks, most bonds are not traded publicly. Instead, they're traded over-the-counter, or OTC, between large broker-dealers acting on their own or as agents for investors. So, where do you fit in this equation? As an individual investor, you typically buy and sell bonds through brokers. These brokers connect you to the broader bond market, providing access to a wide array of bonds to choose from. They also provide valuable services like research, advice, and trade execution. Now let's dive a bit deeper into the buying process. When you decide to buy a bond, you're essentially lending money to the bond issuer. This could be a government, a municipality, or a corporation. In return for your loan, the issuer promises to pay you a specified rate of interest during the life of the bond and to repay the face value of the bond when it matures or comes due. Sounds straightforward, right? But here's where it can get a bit tricky. If you decide to sell the bond before it matures, the price you get could be more or less than what you initially paid. This is because bond prices fluctuate based on a variety of factors, including interest rates, credit ratings, and time to maturity. Understanding these factors can help you make informed decisions when buying or selling bonds. But what if you're not comfortable navigating the bond market on your own? That's where online trading platforms come into play. These platforms simplify the process by offering easy-to-use tools and resources. They allow you to search for bonds based on your specific criteria, view real-time prices, and execute trades with just a few clicks. Plus, many of these platforms offer educational resources to help you understand the intricacies of the bond market. Whether you choose to work with a broker or use an online trading platform, it's important to keep in mind that buying and selling bonds involves risk. Just like with any investment, there's the risk that you could lose money. But by doing your homework and understanding the market, you can mitigate these risks and make informed decisions. In conclusion, the process of buying and selling bonds involves understanding how the bond market works, knowing where and how transactions occur, and considering the role of brokers and online trading platforms. It's not as daunting as it may seem at first glance. In fact, with a bit of knowledge and understanding, it can become a straightforward part of your investment strategy. With a grasp on how to buy and sell bonds, let's move on to understanding bond prices and yields. Bond prices and yields have an inverse relationship, a key concept in bond investing. Picture a seesaw. When one end goes up, the other goes down. This is exactly how bond prices and yields behave in the financial market. Let's start by understanding what a bond yield is. Simply put, it's the return an investor gets on a bond. If you buy a bond for $100 with a yield of 5%, you'll earn $5 a year. Now, let's consider bond prices. The price of a bond fluctuates in the market based on several factors. Two of the most influential factors are interest rates and credit ratings. When interest rates rise, bond prices fall. Why so? Well, imagine you purchase a bond with a 5% yield. Then, interest rates increase and new bonds are offering a 6% yield. Your bond, with its lower yield, is less attractive to buyers. Hence, its price drops. Conversely, when interest rates fall, bond prices rise. Your bond with the higher yield becomes more attractive and its price increases. Next, let's look at credit ratings. Credit ratings are like report cards for issuers of bonds, providing a measure of their ability to repay the debt. Higher credit ratings mean lower risk and therefore lower yields. Lower credit ratings, on the other hand, signify higher risk, and these bonds need to offer higher yields to attract buyers. So when a bond's credit rating goes up, its yield goes down and its price increases. Conversely, when a bond's credit rating goes down, its yield goes up and its price decreases. So why is this inverse relationship so vital for you, the investor? It's because understanding it can help you make better investment decisions. If you believe interest rates will rise in the future, you might want to avoid buying long-term bonds as their prices will fall. On the other hand, if you think interest rates will decrease, buying long-term bonds could be a good strategy as their prices will rise. Similarly, if you see a company's credit rating is about to improve, you may want to buy its bonds before the price goes up. Conversely, if a company's credit rating is about to go down, you might want to sell its bonds before the price drops. By understanding the relationship between bond prices and yields, you can strategize your bond investments based on your predictions of interest rates and credit ratings. It's like a game of chess, where you need to think a few steps ahead to make the right moves. Now that you understand bond prices and yields, let's explore how bonds can be a part of your investment portfolio. Remember, investing is not about guessing. It's about making informed decisions. The more you know, the better your decisions, and the greater your potential for financial success. Bonds can play a crucial role in your investment portfolio, offering balance and stability. Imagine your investment portfolio as a ship sailing on the unpredictable sea of the market. Stocks are your sails, catching the wind and propelling your ship forward during favorable conditions. But when the weather turns stormy, you're going to need an anchor. Bonds are that anchor, offering a balance to the volatility of stocks. Let's delve deeper. When you invest in bonds, you're essentially lending your money to an entity, be it a corporation or a government. In return, they promise to pay you a specified rate of interest over a fixed period and to return your principal at the end of that period. This steady stream of income from interest payments can be a great source of consistent revenue, especially in a stormy market. But that's not all. Bonds also add diversification to your portfolio. Not all investments perform well at the same time. When stocks are doing well, bonds may not be, and vice versa. This inverse relationship can provide a safety net, helping to smooth out the ups and downs and reduce the overall risk of your portfolio. You might be wondering, should I invest all my money in bonds then? The answer is a resounding no. Like any investment, bonds come with their own set of risks. Interest rate fluctuations, credit risk, and inflation risk are some of the factors you need to consider. This brings us to the concept of a bond ladder. A bond ladder is a strategy of buying a series of bonds with different maturity dates. This way, you can take advantage of different interest rates and reduce the risk of all your bonds maturing at a time when interest rates are low. And just like that, you've anchored your ship with bonds. They may not be as flashy as stocks, but their steady, reliable nature can be a beacon of stability in a turbulent market. Bonds can provide a steady stream of income and help mitigate risk. But how do you evaluate a bond's potential? That's what we'll discuss next. Evaluating bonds involves analyzing several key factors that can impact their performance. When it comes to evaluating bonds, there are a few critical elements to consider. The first one is the credit rating. Credit rating agencies like Standard & Poor's or Moody's assign ratings to bonds based on the issuer's ability to repay the debt. A high rating like 8AA indicates a low risk of default, while a lower rating may signal higher risk. But remember, a higher risk bond often offers a higher potential return to compensate for the increased uncertainty. Next up is the yield to maturity, or YTM. This is the total return you'll receive if you hold the bond until it matures. The YTM takes into account both the interest payments you'll receive and any gain or loss you'll make when the bond is repaid. It's expressed as an annual percentage rate, making it easier to compare with other investment options. But keep in mind, the YTM assumes that all interest payments are reinvested at the same rate, which might not always be the case. Then we have the duration of the bond. Duration measures how long it will take for the bond's cash flows to repay the invested amount. The longer the duration, the more sensitive the bond price is to changes in interest rates. So if interest rates rise, bonds with longer durations will typically fall in price more than those with shorter durations. This can be a crucial consideration for investors who may need to sell a bond before it matures. Lastly, let's talk about diversification. Just like with any other investment, it's important to spread your risk when investing in bonds. By diversifying, you can mitigate the risk of any one bond or issuer underperforming. This might involve investing in bonds from different issuers with different credit ratings, maturities, and durations. Remember, every bond is unique and carries its own set of risks and rewards. Some investors may prefer the stability and predictability of government bonds, while others may be willing to take on the additional risk of corporate bonds for a potentially higher return. It's all about finding the right balance for your individual risk tolerance and investment goals. Evaluating bonds is not just about looking at the numbers. It involves understanding the broader economic environment and the specific circumstances of the bond issuer. Are interest rates likely to rise or fall? How is the issuer's industry performing? Are there any legal or regulatory issues that could impact the issuer's ability to repay the bond? These are all questions that can help you make a more informed decision. So there you have it. Evaluating bonds involves a careful analysis of a range of factors, from credit ratings and yield to maturity, to duration and diversification. It's a complex process, but with a bit of research and due diligence, you can make informed decisions that align with your investment goals. Evaluating bonds is crucial to making informed investment decisions. Now let's wrap up with some key points to remember. Navigating the bond market can be complex, but understanding the basics can give you a strong foundation. We've traveled through a lot of ground today, so let's recap the essential points from our journey. First, we delved into what bonds are. They're essentially IOUs issued by entities like governments or corporations, promising to pay back borrowed money with interest. This concept forms the basis of the bond market, a vast global financial network where these IOUs are bought and sold. Next, we explored the different types of bonds, from corporate bonds issued by companies to government bonds like treasuries and municipal bonds. Each has unique characteristics and risk profiles, offering a range of options to suit different investment strategies. We then discussed how bonds are bought and sold, whether through a broker, a mutual fund, or an exchange-traded fund. Understanding the process can help you navigate the market with greater ease. Our journey continued with an examination of bond prices and yields. We learned that bond prices and yields move in opposite directions, a key concept to grasp when making investment decisions. We also looked at the role of bonds in your portfolio. They can provide a steady stream of income and act as a buffer against the volatility of the stock market, making them a crucial part of a balanced investment strategy. Finally, we tackled the art of evaluating bonds. We learned about credit ratings, yield to maturity, and other critical factors that can help determine a bond's potential risk and reward. Remember, bonds are not just pieces of paper or digital entries on a screen. They represent a promise, a commitment, and just like any other investment, they come with risks. But with the insights we've shared today, you're better equipped to navigate the complex world of the bond market. Thank you for joining us on this journey through the bond market. Remember, informed decisions are the best decisions. Until next time, keep learning and investing wisely.